Hello, traders. Welcome back to Tradex, where we help you trade fast and think smart. In today's video, we are going to talk about one of the most powerful concepts in trading liquidity. If you're not sure what liquidity means, which liquidity levels are the most important, or what liquidity zone is, this video will make everything clear for you. By the end, you will understand how liquidity works, how it drives price movement, and how you can use it to make better trading decisions. So, let's begin. In trading, liquidity refers to how easily an asset can be bought or sold without creating big price changes. A highly liquid market means there are many buyers and sellers, and trades can be executed smoothly. When liquidity is low, even a small order can move the price a lot. You can think of liquidity as the blood flow of the market. Without it, price can't move freely. That's why major instruments like Forex pairs or the S&P 500 are considered highly liquid, while exotic pairs or small cap stocks are less liquid. Now let's talk about liquidity levels. These are specific price areas where a lot of stop loss or pending orders are waiting. The first liquidity in a price wave is usually the most important. It often has the highest chance to hold or resist price because it contains the earliest cluster of orders. In an uptrend, the furthest liquidity level below the last higher low is usually the strongest. In a downtrend, the furthest level above the last lower high tends to be the most significant. These levels attract price because they represent large groups of orders. Price naturally gravitates toward them to collect liquidity before continuing its move. A liquidity zone is a wider area on the chart where price begins to react to the opposite side. For example, when the market is rising and starts to hesitate, that area likely contains sell side liquidity. When price is falling and begins to bounce, that area likely holds buy side liquidity. In simple terms, above previous highs, there is a buy side liquidity, and below previous low, there is sell side liquidity. These zones are where price collects stop losses and pending orders before making its next move. You might ask, why is liquidity so important? Because every meaningful market move, whether it's a rally, a sharp drop, or a sudden reversal, happens around liquidity. The market needs liquidity to move. Large traders cannot open or close massive positions in random places. They need areas filled with opposite orders. That is why the market is constantly hunting liquidity zones. They provide the fuel that moves price. When you understand where liquidity is, you're essentially seeing where the market wants to go next. Before we continue, let me quickly introduce our products. At Tradex, we design and develop professional indicators, expert advisors, and utilities for MetaTrader 5. Each product is built to improve your performance and bring more clarity to your trading. If you don't know how to buy a product on MQ5, watch the video above where we explain entire process step by step. And if you have an idea for a trading tool or a profitable strategy, we can build it for you through our custom development service. All the links are in the description and in the pinned comment below. Liquidity enters the market through traders' orders. And there are two main types: limit orders and market orders. A limit order means you want to buy or sell at a specific price. For example, I want to buy at 1.2050. This order is placed in the order book and adds liquidity because others can trade against it. A market order, on the other hand, means buy or sell right now at the best available price. These orders consume liquidity because they remove existing limit orders from the book. That's why traders who place limit orders are called liquidity providers, while those who place market orders are liquidity takers. Whenever the market moves in one direction, it must consume the liquidity on its path. And when you place a market order, the market consumes your liquidity too. Let's now talk about institutional traders. Their biggest challenge is that they trade very large amount of money. If they enter or exit the market all at once, they create big price movements that work against them. So, instead, institutions use a different approach. They create situations in the market that attract retail traders. They drive price toward obvious levels to trigger stop losses and breakout entries. Once enough opposite orders are triggered, institutions can enter or exit the market quietly at better price. This is how liquidity manipulation happens. A liquidity sweep happens when price temporarily breaks above a previous high or below a previous low to collect stop loss orders and then quickly reverses. This is not random movement. It is how the market collects enough orders before continuing in the main direction. You can think of it as the market saying, "Thank you for the liquidity, now I can move." Liquidity sweeps often appear before strong reversals or trend continuations. Spotting liquidity becomes easier once you know what to look for. Look for equal highs and equal lows. These are common areas where stop losses are placed. So price often sweeps them. Watch swing highs and swing lows. These are natural liquidity points. Pay attention to consolidation ranges or sideways movement. Liquidity builds up there because many traders place orders on both sides. And finally, trend lines with multiple touches often hold large amounts of liquidity just beyond them. Remember, liquidity acts like a magnet. It pulls price toward itself so the market can collect orders and gain momentum. Now that you can identify liquidity, how can you actually trade it? Step one is to identify the market structure. Look for a break of structure or a change of character that confirms the direction. Step two is to wait for a liquidity sweep. The price should take out the liquidity and then show a clear rejection. Step 3 is to look for an entry confirmation. This could be a candlestick pattern, such as a bullish or bearish engulfing candle, a pin bar, or a break and retest pattern. Step 4 is to place your stop loss just beyond the liquidity that was taken. And finally, let the trade run. Liquidity moves often lead to strong and fast price swings. So avoid cutting your trades too early. If you're not sure which candlestick pattern to use, watch the video above. It explains the most effective ones for confirmation. One of the most common mistakes traders make is treating liquidity zones as support or resistance levels. Liquidity zones are not levels to buy or sell from, they are targets that price moves toward. Instead of asking where price will stop, start asking where price wants to go to collect orders. This small shift in thinking can completely change how you see the market. Let's quickly summarize what we covered in this video. Liquidity is the fuel of the market that allows price to move smoothly. The first liquidity in a wave is often the strongest. Liquidity zones from where price begins to react to the opposite sides. Institutions use liquidity to enter or exit large positions. Liquidity sweeps occur before big moves, and trading liquidity means waiting for price to grab it. Then entering the trade with confirmation. Once you start looking at the market through liquidity, everything becomes clearer. You begin to understand why price moves, not just where. Thank you, traders, for watching this video. At Tradex, every educational video we publish comes from years of research, testing, and real trading experience. Our mission is to help you understand the market deeply and trade with confidence. If you found this video helpful, make sure to like it, subscribe to our channel, and watch the next videos on your screen to continue learning more about smart money concepts and technical trading. Until next time, trade fast, think smart, and see you in the next video.